Hello and welcome to Raise Your Average. I'm Pierre Daly, Managing Editor at AdvisorAnalyst.com. My co-host is Mike Philbrick, CEO at Resolve Asset Management Global. Our very special guest today is Andrew Beer, Managing Member at Dynamic Beta Investments, one of the oldest firms doing liquid alts. His firm's mission is to roll out ETFs that look like hedge funds, except with full transparency, liquidity, and none of the high fees. What he and his colleagues do is in a unique and fascinating dimension, bringing Jack Bogle's philosophy to the hedge fund space. If you're looking at all at liquid alts or managed futures and want to learn more about how these things work, stay tuned. You'll find this to be an enlightening and insightful conversation.
The views and opinions expressed in this broadcast are those of the individual guests and do not necessarily reflect the official policy or position of AdvisorAnalyst.com or of our guests. This broadcast is meant to be for informational purposes only. Nothing discussed in this broadcast is intended to be considered as advice.
Andrew, it's terrific to have you on the show. Thank you so much for joining us.
Thank you both very much for having me. It's a pleasure to be here today.
So, Andrew, to kick things off, tell us about the arc of your career, how you wound up in the investment management business.
Well, it wasn't obvious at all, actually. I graduated from college and I wasn't sure what I wanted to do, and I ended up going to work as an M&A investment banker in New York, and then I went back to business school, and I started to get interested I thought I was going to go into the LBO business. Back then, all the cool, smart kids ended up going into the LBO business, and I wanted to be part of that. And then in my second year at Harvard Business School, I ended up meeting this guy. I got actually recruited to go on an interview with this guy named Seth Klarman, and he was one of the early generation of hedge fund guys. And I walked in not knowing what a hedge fund was, but these guys, just drilled me with questions for about an hour, and they seemed incredibly smart, and they were doing, all the things that they were doing seemed really esoteric and interesting. And I was kind of hooked. And so I went there. Ended up being a generalist portfolio manager for about 3 years, and then ended up leaving. And since the late 1990s, I've been starting and running my own businesses in different areas of originally the hedge fund space, and then more recently, as you mentioned, in the liquid alternative space.
So Seth Klarman, wow. Let's talk about your time at Baupost a little bit. Seth Klarman, author of Margin of Safety, the little book that costs $2,000 on Amazon.
I think I still have mine with bona fide fingerprints on it, so I should get a premium for
absolutely
for it. Look, I mean, Seth is absolutely brilliant, and it was a privilege to work for him. I think it's, even though he's considered a hedge fund manager, his firm was not so much a hedge fund as it was more of a multifamily office. That he wasn't. This was the early days of hedge funds. When I joined, they had $600 million in assets, and they were probably one of the 10 largest hedge funds out there. 3 years later, when I left, it had $1.8 billion.
Yep.
And, again, I had zero to do with that growth. It was all about people realizing that hedge funds were doing things that were really unique and arcane and interesting. And what I had an opportunity to do was to walk into the office every day and, with a blank sheet of paper and say, what do we do now? How do we find things that are cheap? And, in retrospect, looking back on it, it's just incredible how much the markets have changed since then. The things that we were doing back then, I did some of the first purchases of limited partnership interest in secondary transactions. There was no developed market for it. And we were buying them at 25 cents on the dollar. But you'd have to do months and months of work with not a whole lot of information available and negotiate it and go out and find them. It was always, and you could put a couple $1 million to work, but the discounts were huge. And then, I think one of the great lessons is here we are nearly 30 years later, and just everything is more efficient. The idea that you can kind of find things that are just utterly obvious investments, it's much harder, much more competitive today.
I would agree with that, but so on what dimensions do you look at that? How have you kind of looked at that dimensionality of competitiveness? Is it the efficiency of the markets, the efficiency of the information, just the absolutely massive amount of IQ that's being put at these problems to solve them? Is it all of those things? Am I missing a couple? What's been your experience?
So I think it's across the board. I think Yeah, I got asked a couple of years ago to write a book about what's changed in the past 25 years, and when I sit down to do that, I will be able to articulate it much more clearly than I can right now. But take the value factor, right? I mean, so I joined in 1994. Fama had published this paper, I think, 2 years earlier, so I was aware of it, and I almost went into the doctoral program at Harvard Business School. Actually, the guy who convinced me not to go into the doctoral program was the head of the doctoral program, who said, "You'll hate it." So he kicked me back into the private sector, and I'm very glad that he did. But I knew about the value factor, and I go and I work for Seth, and the first thing I do is I try to do screens of publicly traded companies. It wasn't easy to do then. I mean, where do you get the information from? You could get it from FactSet, but the FactSet data was lousy. You could, Bloomberg was in its infancy relative to what you can do today. The whole idea of even factors was very novel. I mean, these are papers that had just been published, but in terms of and I would actually compare 1994 to the late 60s through 1990, which is the period that Fama studied. The kinds of stocks that he was talking about were gone. They'd all been bought, LBO'd, recapped. And in a sense, what he had described was a period of time that had passed.
Right.
That the idea that there was some company that had some lousy manufacturing business but happened to own a third of downtown Atlanta that was priced at cost because they'd owned it since 1901, that company didn't exist. And the really interesting question is why that factor did what it did for so long. And again, so my job was relatively easy compared to, imagine trying to do it in 1978. You're dialing on your rotary phone to call information in Boise, Idaho, to get the number of a company. You call the company, you ask for investor relations. They put an annual report in 10K in the mail. You get it 2 weeks later. You're using the Wall Street Journal to get recent price information. You're doing everything on the back of an envelope. This is why when you hear about Warren Buffett sitting in his attic and reading annual reports all day long, it's because there was no other way to get that information. And so, so when you compare that period, and then now you can fast forward it today, what I see in the market is, when an idea becomes popular, it gets adopted very, very quickly. People pile into it. The dissemination of information is almost instantaneous. That makes it harder.
Certainly.
And so, yeah, so you've got the dissemination of information across all of these users of the information, and then the implementation of that more quickly. So where can an investor find an edge? Where is it that what are the top places that those edges have gone away or been attenuated to some degree? And whether we're systematic with in some of the things that we do, you're systematic or not systematic, you're laying the expertise of an individual human and their wetware to make decisions. So what are the edges that are left for the investor to pursue?
Sure, I think the two big ones are constraints and heuristic biases. That a typical investor does not want to stray too far from the pack. And so, when I talk to a pension plan that, it feels like they're going over their skis into EM, they're going from 5 to 7%. Hedge funds do it, they'll go from 5 to 35%. So the absence of constraints is one of the, you cannot take an incredibly talented investor, tell them that, take a great mixed martial artist and tell them they can't use, one of their fists and both of their feet and expect them to do very well in the ring. And then the other is heuristic biasing. And so, the reason I got really interested in managed futures as a space is because I think it solves one of the problems that people have in their portfolios is that there is a common heuristic bias that permeates most investment decisions. And managed futures, because these are robot strategies that have no emotions, they tend to not have those same biases and therefore add a really, really compelling element of returns.
Right. So that systematic or rules-based approach where you're looking at the data through specific lenses, and it doesn't matter how you feel or how you woke up this morning or whether your wife yelled at you and your kids are crying and everybody's sick, like you're still going to make the decisions over and over again. And you hope to have some sort of edge. Now, what do you think about from the perspective of over the last 10 years, save the last 6 months? The other thing that's been fairly difficult for those who are in the multi-asset space, not just CTAs, but those considering large swaths of assets beyond just sort of, technology or US equities, this lack of dispersion seems to me to have been a particularly challenging environment to produce differentiated returns. That seems to be attenuating, but what are your thoughts there?
I guess as a guy who lives in factor land, I think there's been tremendous dispersion. It's just been the worst kind of dispersion. When the S&P 500 becomes dominated by tech stocks, and that dominates every other market, and that's everyone's essentially the equivalent of their home currency or their home investment. Again, I'm dealing with predominantly U.S. investors, but then if you deal with the MSCI World, it's 55 or 60% effectively the S&P 500 anyway. I think the problem hasn't been dispersion; it's that nothing has worked as well as the basic trade. And so, what I think is interesting now, when you think about the 2020s, given the fact that we thought the rubber band between the U.S. and other markets expanded, and we thought it couldn't possibly go any further, and then it expanded further. It couldn't possibly go, and then we get COVID, and and now it feels like all these expensive tech stocks were going to finally get their comeuppance and value would come back, and then it just went completely in the other direction. But I think all these things do. There is an element of reversion to it. Now, we've had these really, really painful head fakes. About 2 months ago, or about a month ago, you started to hear people talking about the revival of emerging markets. Finally, we have emerging markets, and then they've just been run over over the past couple of weeks. But I do think that a lot of these things, when other asset classes outside of those basic building blocks that dominate 60/40 portfolios do better over time, then a lot of the willingness to look at other things starts to play off, and I think that will characterize the 2020s.
Right. The dispersion has been one of losses, negative dispersion, or
sure.
Whether it's been trend or it's been small cap or it's been international, things that would normally diversify the portfolio have diversified the portfolio, but they've diversified it from the standpoint of holding it back. And then you have that loop cycling for a decade, which then leads to, an overconfidence bias in investors and them seeking more and more of what's worked over the last decade, and finally getting so concentrated in one particular area that when that area goes through a decade of lost returns, or the lost decade, which happens often. It's happened in U.S. equities a couple of times, over the last cycles. And it's a strange thing. So, I would urge investors as we're seeing this initial surge in inflation, volatility, and inflation, to start thinking about broadening the scope of investors that they're considering in their portfolio. I mean, potentially we're going to print a 10% CPI this year. And what is in a 60/40 domestic equity portfolio based in the US? What's in that portfolio to offset an inflation spike of that nature? And the answer is not very much. I mean, in 08, go ahead.
Nothing, zero.
Yeah.
Zero. And I think the 2020s will be a lost decade for 60/40 portfolios.
Yeah.
We had, I mean, that was the problem with the 2010 was people were paid to procrastinate. People were paid to concentrate. And, look at a firm like GMO, which made a call into EM in 2014, and it's been paying for it for 8 years. But a lot of it is, the reason I like replicating hedge funds, why do I replicate hedge funds is because, there's always this tension between long-term asset allocation models and current market environment. It would be the ideal thing if we could say we have 100-year capital markets assumptions, just put together a portfolio and everybody goes home and, 4 generations later, somebody is happy with the outcome. But, going back to the question about where I think you can make money, it's the ability to pivot and change what you do depending upon market environments, which is not to say it's not hard, but when we were replicating hedge funds and by the way, what I mean by replicating hedge funds is we try to figure out what they're doing broadly across their portfolios and just copy it cheaply. It's not, we're not trying to copy this stock or that stock, but if they are in May of 2020, we see that they're increasing equity risk. Okay, that's interesting because in May of 2020, a lot of people thought we were never going to reemerge from lockdowns. The world is going to go to hell and stay awful despite what the Fed was doing. They were increasing equity risk. And then by the fall, it was apparent that the equity risk that they were adding was not going back into Facebook and Microsoft and Apple. They were buying stuff that had been crushed, like oil and gas companies. When oil had gone negative, they were buying retailers. They were buying, and so for us, outside of this kind of paradigm of how you specifically define value, these were cheaper things. And so hedge funds that had been very growthy during a very good time for growth stocks were now becoming very value-ish at a very, very different time. And I think actually, so I'm optimistic about active management, a very particular kind of active management in this world that we're going into, or that we are in right now, because I think, there is no 5-year playbook that anybody has, that anybody should be confident that it's going to work out the way you think.
Well, I think that the people are positioned generally for what's happened, not what is happening or about to happen potentially.
Sure.
And then this comes back to my point about dispersion. You now have very differentiated returns across a spectrum of asset returns, which you are now able to consider, that are very different than the current zeitgeist. So I wonder if we can dig into what's the process of going through, and I think this is where you were headed, Pierre, too, right? What's the process? You've decided it's either, maybe it's long, short, maybe it's market neutral, maybe it's the CTA space and, global macro. And as you said, you like to be systematic. How do you go through, deciding on what factors to emphasize, or are you just trying to look through the portfolios and duplicate what they hold? How do you go through that process? And maybe take us through an example that you have found is good at sort of giving us an analogy that we can all understand best.
Sure. So maybe I'll go back to the beginning, because I kind of fell into this space. So I was super active in my 30s. I had started 2 different hedge fund businesses that were growing a lot. And then I was sort of known as a guy who got in I got in very, very early in China, and I got in very, very early in the commodity markets, both starting hedge funds in those areas. And so I got a call, and he said, I want you to come meet a quant friend of mine. And I go and I sit down. I'm not a quant. I'm a history major. I'm decent with numbers, but I don't program. I don't run my own statistical analysis. So I go to meet with a quant, and he talks about what he does. I said, I don't know how to make sense of that. And then he said, there's this interesting thing called hedge fund replication. And I said, I have no idea what that means, but tell me. And he said, basically, you can use what's essentially a risk model, a version of Sharpe-based style analysis, to figure out the major positions among hedge funds, and you can invest in them directly. And I said, well, of course. And he said, well, what do you mean, of course? I said, because that's how hedge funds have always made money, right? It's not about, which value stock they owned in 2000 and which large cap tech stock that they shorted against it. What mattered was that they were in things that went down. They went down 40, not 50, but they were short things that went down 80, not 50. That's how they preserved capital. And I said, well, let me just ask you, just in terms of to see if it works or not, what do you see today in the model? And he ran it, and he said, almost, it looks like there must be something wrong. It's about 35% emerging markets. And I said, then it's right. It's working. And he said, well, why do you say that? It's because I said 3 years ago, everyone got obsessed with this brick trade. When Jim O'Neill at Goldman Sachs coined the term brick, everybody wanted to be involved in emerging markets. Everybody jumped on planes to go to Beijing and Shanghai to see what was going on. People were talking about, the growth of commodities, the growth of the middle class. Every hedge fund that I knew, if they didn't own fertilizer companies to play on this, they owned cement companies. If they didn't own cement companies, they owned crane manufacturers. It was all around an EM growth theme. And so here was an industry that had gone from one very distinct bet a few years before, and it pivoted what they'd done. They had, cast off the value versus growth trade and gone into a long brick trade. And then so what you see are these kind of rotations and pivots over time. And they're driven not generally by somebody at the macro level saying, like GMO saying, I think, value stocks are emerging market stocks are cheap on a PE basis. Rather, it's because, when I talk to hedge funds about it, they're like, look, we look at the footnotes of these companies. We interview the management teams. But if we like one company that's doing things in Argentina, we fly a team down, and then probably we like 3 or 4 or 5 companies. And if we like them in Argentina, we probably like them in Brazil too. And lo and behold, 2 years later, we've got 20% of our assets in this. So that idea of adaptability, fundamental stock selection, fundamental asset selection, leading to these rotations in factors at the portfolio level. Now, from my perspective, then, you can either hire lots of expensive hedge funds to do all of that difficult work, but if you can just use a model to decompose what they're doing and figure out that they're long 35% EM and invest in a futures contract to get the same exposure, but for free, and you can charge less to do it, I like that. I think that's a better value proposition.
And then how does the delay in that impact? I mean, obviously you're not charging the owners performance fees. The fees are a little lower. So it's not like you have to capture all of the upside in order to match the upside if you're not charging those things. So how do you find that delay from them positioning themselves in order for you to suss out that they've positioned themselves that way, both on the way in and on the way out? How has that lag in and out been? How do you address it? How does it affect things?
Sure. So in our space, the first thing, and this harkens back to learning at the feet of Seth Klarman, is first thing is don't do it if you don't think it's going to work well. So there are a lot of things you should not try to replicate. Right? It's better just go home and admit that you can't do it. We cannot replicate Millennium. I wish we could. Right. And find a way to deliver a 2.4 Sharpe ratio with daily liquidity and low fees. Ain't going to happen. So there are specific things we can replicate: equity long short, we can replicate managed futures, and then we can replicate very broad-based portfolios of hedge funds. The delay issue happens. Different kinds of portfolios have different speeds associated with them. So another thing you don't try to replicate is you don't try to replicate Fred, the hedge fund manager. You don't try to replicate Ray Dalio over here, because they will change their mind faster and we won't know it. But 50 of these guys together, while one guy is thinking that we're on the cusp of World War III and is dialing down risk across his portfolio, there might be another guy in there who thinks this is a great buying opportunity and we're about to see some really positive news. So you replicate large pools of funds to figure out how, on average, they're changing their positions. And in a space like equity long short, they change their portfolios slowly. How do we know this? Because we know how they invest. So if I'm an equity long short guy, and I've spent a year researching a company and talking to management and made it's now a 7 or 8% position in my portfolio, and I think this stock is going to double over the next 5 years, there is not a headline that I can read that is going to cause me to sell that thing tomorrow. It's just not the way I think. I may reduce it at the margin. I may stop buying something else. I may have something that's gone up that I want to dial back, and I may do some hedging or something at the margin. But going back to your whole thing about heuristic biases, that's a drawback on what these guys do. Once you own something and you put all of that work into it, it's very, very hard to turn on a dime. And so equity long short, the portfolios move slowly. Broadly across the industry, they move slowly. Managed futures move fast. And so managed futures, we can't rebalance once a month. We need to rebalance at least once a week. And we're always looking back at these kind of, really what happened over the past few weeks to guide us as to where we should be positioned today. Doesn't matter what they were doing 6 months ago.
And on the so a couple of questions. Yeah. So for both of these types of approaches, how is it that you think about the risk management along the way? So you've got this indicator, you've got to put a trade on, you've got to set some risk mitigation around that, both, as you said, trimming it on the upside or eliminating it on the downside. And you in the equity space, you haven't really done the work, right? So you're mimicking the work from somebody else or the group of people. You're polling a group of portfolio managers, and you're getting here's on average what we like. And so how does that, is there sort of set criteria in the rules of each portfolio that you've systematically managed that you're going to equal weight, or do you take some sort of weight based on the percentage weight that you're getting from the manager? How do you handle that? And I want to have some CTA questions as well.
Sure. So the basic framework is we're inheriting all of their risk management.
I see. Okay.
Right. If you have 50 equity long short funds or 20 managed futures funds, you will have a cowboy who will drive off the cliff. I'm mixing metaphors, but you
it's a
get
good
the
mixed
idea.
metaphor. Though. I'm the mixed metaphor guy,
Yeah.
so they speak to me.
Yeah.
So I totally know what you meant.
So look, I mean, you'll have wild guys, but when you do like in the managed future space, you might have one guy who's a 15 vol, but you'll have
Sure.
other guys who are lower vol, and they all have their own businesses to manage. So, what you don't get when you're looking at the managed future space, you don't see, okay, we're all 190% short the 10-year treasury, and that's all that we have, because each one of them has their own position limits, diversification criteria, VAR limits, et cetera. When you get into, there are a lot of practical issues when managing things in the context of an ETF in the U.S. or a UCITS fund in Europe. We also manage a product in Japan. We manage one in Spain. Each one of these has structural nuances and constraints. And fortunately, I have a partner who is genius caliber at this stuff, so I can remain blissfully ignorant and just see that it works the way we would suspect. But in all seriousness, I mean, that's where you get into the issues. The thing is that most, a bona fide hedge fund strategy that has illiquid assets, illiquid things, big derivative positions, et cetera, has a very, very hard time getting jammed into a mutual fund. And I assume it's the same thing in Canada. So you end up losing a lot. I actually wrote a paper about this in 2013 that lower fees relative to hedge funds was actually a red herring, because if you're losing so much of the pre-fee returns and then making a little bit back on fees, you are still coming out, way behind. And so what we do basically is we start our whole. Someone once described us as unique in the liquid alternative space, in that we have consistently done better than actual hedge funds, but with low fees, daily liquidity, less downside risk, et cetera, being able to make it work in a UCITS fund. So how do you do that? Well, first thing you do is you aim for their pre-fee returns. Because in hedge funds, people have been railing about fees for a long time. It's very uneven across the industry, but they really haven't come down as much as you would think. If you said, here's an entire space that did, let's say, 4% in the 2010s after 300 basis points in fees, you would have thought there might have been more competition around it. But in reality, some people are raising fees and some people are lowering fees a lot. But we coined a term back in 2011 that in hedge funds, fee reduction is the purest form of alpha. And what basically meant was that if I invest at 1 and 5 and you invest in 2 and 20, I'm always going to win. Like in the U.S. retail space, it would be if I invest in an institutional share class with a 100 basis point expense ratio, and you invest in a retail share class with a 5% upfront load, guess who's going to win over time?
Well, all things being equal, right? We have to determine that we're receiving the same value, that we have the same vol count. Like, this is another thing. Fees should be subject to some sort of vol filter, because if I'm manufacturing a 20 vol CTA, well, you only have to buy half as much as if I manufacture a 10 vol CTA. So I have to have half the AUM. So potentially I should be charging a higher fee for that differentiated return source. You get more real estate into your portfolio, and sometimes that's a benefit. These are all things that individuals have to make as decisions along the way.
Sure. So Millennium, I'm the only guy. I mean, I defend Millennium's 800 basis points in fees, because if somebody can take $1 and make it turn into 10 that works without blowing up over 30 years, they deserve 800 basis points. Like that's not on a, and when we do things that are essentially leveraged, we charge more.
So this is, I was just trying to add a little bit of extra light on that. Yeah.
Sure. But when you're talking about an industry where 80% of the alpha has been paid away in fees over 10 years, for us, it's a pretty low bar. So our goal is generally, if we can replicate 90% of the pre-fee returns of a hedge fund portfolio, charge less, we'll do about 200 basis points over time. And back to your question about what's the risk characteristic of what we do versus what they do, we tend to actually show lower risk over time, because hedge funds, some of those things that people talk about and tout with hedge funds as having great alpha-like characteristics, illiquid assets. So in 2019, if you'd said to a big fund of funds, what's your favorite area of hedge funds? They probably would have said structured credit, because they were getting, 6 or 7% returns with almost no visible volatility. Well, it turns out that stuff was really illiquid and really highly leveraged. And in the first quarter of 2020, it went down 25%. Some funds went down 50% and gated investors. So illiquid assets can have huge downside characteristics at the wrong time. Single stock positions, the same thing can happen. Single stocks, get crowded. And going back to the point about what's changed, it's no secret anymore who owns stocks. When Tiger Management blew up in 1997, or I think it was the fall of 1997, the hottest piece of paper on Wall Street was a list of their positions. The idea that you could pull up 13F filings and find out what Tiger Management didn't exist. These were things that were handed underneath the coffee table to your best friend, who was XYZ hedge fund when you worked at XYZ investment bank. But now we when Bill Ackman owns a stock, there are a million Menorah who follow his trade. Not Menorah, Nemora, sorry. Not menorah. Waving the menorahs. Sorry, remora are the small fish that follow a whale. And they'll pile into the trade as well. So when things start to go badly, you get things going down a lot more than you would like. So ironically, when we think about risk in our portfolios, we start with the assumption that there's going to be another Lehman, that there are going to be market dislocations, that some counterparty somewhere is going to blow up that nobody knew. So we don't do anything on the OTC market. We don't do anything with counterparty risk. We don't do anything with liquidity risk. All we trade are the deepest, most liquid futures contracts, and have basically U.S. dollar denominated cash and cash-like instruments.
So that's great. So just kind of going back and summarizing a little bit. So on the long short side, the position risk sizing is really a culmination of all those portfolio managers and all their risk management.
Yeah.
Right. That's actually really cool. I think that's, so you've got somebody who's got large single stock positions. You've got somebody who's being conservative. You've got this bandwidth. You'll have various different levels of vol. Have you considered the vol sizing of what the output is at all, sort of in conveying that back to investors? Or is that sort of, no, we're going to let the signals tell us what the vol size should be, maybe with a cap or something like that. But how do you guys think about that particular part of the equation?
So our basic model is we're going to follow what they do. Mm-hmm. That's our job. We have numerous different products that have been built for different, generally larger asset management firms who want us to build things for them, and then they do all the heavy lifting on that side and we manage the portfolios. They sometimes have criteria that they want. So we have a fund that we run in Europe that has a vol overlay that we try to bring it down to a 5 vol because that's what their investors want. I personally think that as these things, a lot of those kind of design decisions, I don't view them as adding value, but rather meeting a constraint that's important to a population of investors for reasons sometimes that I don't see.
They're bespoke based on their needs and what their requirements are, and that's where the tailoring comes in, and that's why you guys offer that service.
Exactly.
Now, on the CTA side, is it any particular factor, or are you seeing through to their, in order to gather, are you looking at commercials, speculators, the positioning? Is it trend? Is it trend carry? Is it like, are there any things that you're imparting, or you're trying to suss out the type of factor that they're using, or is it just gross positioning?
It's gross positioning. So basically, and my view, when we looked at this back in 2015, what we were trying to do is, so my take on managed futures, it's got two great characteristics. It tends to have zero correlation to equities and bonds over time, but make no mistake, it goes up and down over time, right? So you've got to have a multi-year outlook. Otherwise, you'll get whips. I mean, it'll get dizzying watching go up and down. And the other is it tends to do well in a crisis. Now that's something that people love to wave around statistically. We have two data points, right? We have 2000 to 2002, we have 2008, and then March of 2020, it was okay, but things happened too fast for it to really be borne out. But as an investor, having been through a lot of these things, going back to the non-emotional part of it, what I do think that managed futures has a huge competitive advantage in a period like that we're in right now, because things just move farther than you expect. And every time it moves a little bit farther, a certain group of investors peel off and think it's going to reverse, and it's just how we're wired. Managed futures doesn't care. They don't care what intrinsic value is. They don't care about any of that stuff. The two problems historically, from our perspective, have been, one, when you layer in all of the fees and expenses of a typical managed futures strategy, and I mean a flagship hedge fund strategy, it's probably 500 basis points. So when people say, "Oh, I don't like the space because they were doing 2," my response is, no, you picked a space that was doing 7. Right. You just paid way too much for it. And then the second is single manager risk. There's zero persistence of returns. I believe there is that manager selection in managed futures is completely efficient. And by that, I mean no one has an edge. The smartest managed futures guy in the world cannot tell you whether medium-term trend is going to do better than short-term trend, whether somebody with a commodity bias is going to do better than somebody with this kind of bias, etc. So the only way, and since you have no persistence of returns and huge dispersion, I believe that anybody who has the constraint of being able to invest in less than 6 funds as part of their managed futures allocation should never invest in a single manager fund to fill that bucket. So what we tried to do was basically create a product that would reduce risk by diversification across lots of guys. In this case, it's 20 hedge funds, and then generate alpha not by picking who's going to do well, but by eating away at that 500 basis points in fees. And so then the whole exercise was, how do you do that? And one of the things we did look a lot about, and I wrote a paper on it, was, maybe it's all being driven by trend. And so it was very fashionable in 2015 when we were doing this work for people to say, oh, managed futures, well, it's just trend. Well, what do they mean by that? And so as we dug into it, if I built a trend model and you built a trend model and Pierre built a trend model, then by the time you end up twisting all of these dials, what markets are we going to use? What look-back periods? What sizing criteria? What vol criteria you describe? We all end up with wildly different results, even though we're all calling it trend. And so it's almost like if I said, what were the equity returns last year? And you said, well, the Golden Dragon, NASDAQ Golden Dragon Index was up this much. And Pierre said, are you kidding me? The E&P, mid-cap E&Ps were up this much. And I said, you guys are, the FANGs were up that much. So if we can't all agree on what the underlying beta or factor is in our modeling, then what it really is it's the average of the people who are employing the active strategies. And so back to, so what we really do is we say we've got lots of really smart guys at managed futures funds who are trying to figure out, is gold going to keep going up? How would I know that as I build my models? Is it going to reverse? What about it relative, is oil at reversing, or do I care? Is it some part of a longer term trend? What about the 10-year treasury? These core positions that they're all going to come to somewhat different results, but we're trying to get the average of it. And like with anything that's indexed, like the average is much more stable than any of the individual positions. And so, so I think the other thing that we realized back then was that there are only about 10 positions that matter in managed futures. That in a certain period of time, like everyone's talking about wheat right now, I doubt wheat is adding more than a couple points of returns to a typical managed futures hedge fund. On the other hand, gold does matter. Gold will, oil will matter a lot this year because it'll also be a larger position because the markets are so much more liquid.
Yeah, I think that there's quite a bit to unpack there too. So I would add that when you employ, let's say you can employ 6 CTAs, there's a significant challenge with that as well, because you have the lack of trade netting. You're paying performance fees in one manager, whilst in the other manager, you have the exact opposite of that trade. Potentially, they may have the other trade on. One's long wheat, one's short wheat. And so you're paying one a performance fee on the long side, but you're losing on the other side. Eventually, you may sell that loser, thereby abandoning that asset, which is the high watermark in which to gain some sort of return back. So you have to be very careful here. This has got lots of dimensionality to it. And I do like the idea that if you're taking all of the trades, this is an interesting way to do the trade netting without having the 6 different or 8 different funds. So that's very interesting. The way we approach it is we do have quite a number of different features and factors. Obviously, we trade net all of that. So, if you're long seasonality and short on trend, then you're going to be flat that position. And you don't want to take both of those positions. Right. But if you have another manager who's got 2 different buckets, that's the case, then you would have those trades counter on within your portfolio. Nice thing, the way you've got it all systematically boiled down. The challenge I would find is that there are some features and factors that do work better than others, and they are often not necessarily what is used on average. So, I do think there is still the opportunity for active management, well, certainly to perform differently and to outperform. The challenge is, can you identify it before the fact, right? And that's where it gets really hard. Can you find Seth Klarman amongst all the other managers that started in 1982? Probably not, right? That's really hard. At some point, though, there's some expertise that's identified in the track record, and that's another ballgame of what the objective function is of the people who are investing in the strategies. Sometimes it is not to have the best opportunity to make returns. Sometimes it's to gain access to the space that is approved by their consultant.
I completely agree with you on so we don't solve every problem, right? What I could tell you is I think you put us up against 6 managed futures, hedge funds, or mutual funds, and I will bet you a tiny nickel that in 5 years we will have done a couple hundred.
You're not trying to be all things,
but
to all people, and you don't have to be, right? And
I'm definitely gonna take a nickel bet on our fund versus I'm definitely gonna do that. We're gonna bet dinner on that. It'll be a great reason to get together.
It's a tiny version
in a nutshell,
of the Warren
in a nutshell,
Buffett
Andrew. Your managed futures ETF basically aggregates the strategies, the multiple strategies of 20 CTAs, and then you manage to get the average outcome of all the CTAs in the ETF. But the most important distinction of all that is that you're not collecting the management fees of the CTAs. You're passing on the bulk of their results.
Yeah, so we
minus the high fees. Right?
Yeah, so we've been able to replicate, by our estimate, we've been able to replicate 100% of the pre-fee and pre-trading cost returns. And so if you look at what we've done over a long period of time, we do 400 basis points better than a broad collection of managed futures hedge funds with daily liquidity in an ETF, an 85 basis point expense ratio. We tend to have equal or better drawdown characteristics. But that being said, going back to Mike's point, I mean, if where I think we have the best mousetrap is if you're a retail advisor and you say, I believe in managed futures as a category, and I want 5% of my portfolio in managed futures. Okay, what does that mean? Okay, managed futures is not someone's trend model. It is not that is the average returns of all the guys who do it, right? This is the equivalent of saying, I can't buy the S&P 500. I can't even buy the individual underlying stocks. My only choice is to buy a collection of guys who broadly invest in U.S. large cap stocks. So that's the only, so I believe that for those guys, what's been missing in the liquid alternative space is something where they can say, here's my 5% allocation. I have manager diversification. I have reasonable fees. It's in a client-friendly wrapper. What that then becomes is a benchmark plus product.
Right.
And the plus is only from cutting out fees. It's not from taking more risk. But the reason that's really important for an advisor is because their constraint generally is they can't fill a 5% bucket with 6 different funds. Yeah. There may not be, I don't know what the Canadian market looks like, there may not be 6 good managed futures funds, and then you get into all the netting and other problems that Mike mentioned. So
yeah, you end up basically running back into the same problem that there was before 3 years ago in Canada, where CTAs and hedge funds were only really predominantly available to rich investors. But now that we've got this democratization of liquid alts in Canada and of course in the US, now you're solving the problem of dividing up an allocation that could be that's a fraction of your assets. But if you're not dealing with a $10 million portfolio or a $100 million portfolio, how are you going to split 50, how are you going to split $100,000 or $50,000 into 6 funds? Right? On $1 million portfolio, let's say 5% is 50,000.
People won't do it. Right. And so what happened in the U.S. So the U.S. I wrote about this, and Morningstar's written about this as well. The central problem with the liquid alts market is that these are all products that somewhere had a good track record somewhere, that generally, at least in the U.S. and in Europe, are launched with firms that have a whole multitude of products, which raises the question, if you think you've got 15 great liquid alt products, why don't you tell me which one you think will actually work? But really, there's a whole series of single manager products at any given point, which a couple of them are doing well. And you've got these marketing teams and then force and go tell people that it wasn't luck, it was skill, and it's going to go on forever. And so the guy who's deciding, what do I do in my 5% managed futures allocation, historically has said, they would look at the top 5 managed futures mutual funds. They would maybe throw out the one guy who had, crazy vol, throw out the one guy who'd had bad numbers recently, they'd pick one of the 3 in the middle. And so if you look at, back in 2010 through 2015, the default, the obvious choice was AQR. And hundreds of thousands of portfolios ended up having a 5% or more allocation with a single manager fund with AQR, because it had decent numbers, it had okay fees, it was big, it was established, it was the easy call. That's as crazy as saying, I want to be in, I want to, add 5% to value stocks and picking that mid-cap E&P producer for a 5% allocation. That's not diversification. That had the appearance of diversification. So what happened to the advisors now is they've got this 5% allocation. They've told their clients that it's not only a great area, but they found the best guy in the area. And then a year later, it's 10% below the benchmark. And so now this 5% allocation is a 30% problem in terms of their time. And what do? Do you get out? Do you replace it with a guy who's been doing better recently? Do you hold on? Well, essentially doubling down. Then another year later, it's down another 10% relative to the benchmark. And so the answer for a lot of people was they finally just said, I'm just going to get out of the whole space because it's easier to blame the space than my pick. And then
Right.
literally they were all out by the time 2020 rolled around, and then 2021 when then managed futures picks up again. So our argument is that there have been very, very few liquid alternative products that are built for a guy with a 5 or 10 year asset allocation objective. And for that, you need broad diversification across underlying funds, and it has to be benchmark plus.
I would add the one point I would add there is that it's for me that the just the 5% allocation is one of, I need to know the vol of the underlying, right? So if I'm buying the market and your vol is lower than the market, I've got certain real estate in my portfolio, and maybe a 5% piece of managed futures isn't going to give me the convexity that I want. So I agree with all the comments generally. Then you have to start getting a little bit more specific as you drill down into what is it that you wanted to achieve. Well, I wanted managed futures to provide some bolstering of the portfolio in a crisis situation. Well, that's not 5%, or if it's 5%, you're going to be looking for a vol that's not even reasonable. So you've got to think about, how am I going to get this suite of products that acts alternatively, i.e. has correlation to a traditional portfolio of maybe 0.1, 0.2, 0.3. But then I've got to have the injection of the capital of the force of that return be meaningful. And so if you got 5% and 5 vol and your portfolio is down 50%, and that 5 vol thing is up 2%, it really didn't do anything. You still have a big headache. And so,
I completely agree, and that's why the only reason. When we built our first portfolio, and this was designed to be kind of a broad kind of hedge fund solution, we had 40% in managed futures. Right. If I told you something has a 2% return, goes up 10 to 15% or 10 to 20% in a bear market, but you might be waiting 7 years at 2% for that to happen, or 7 years at 1% waiting for it to happen, it's very, very hard to hold. If I said, I'm going to get rid of 500 basis points of fees and expenses, so you're paid 6% while you're waiting for that to happen. Yeah. It's a completely different calculus. Sure. From an optimal perspective, you can easily get into 20% or more in a portfolio. Just when I talk to advisors, I'm very aware of what are the realistic considerations of their business. And a lot of the guys that I talk to, I think the biggest compliment I got last year was when an advisor said he'd never met a PM who tried as hard to understand actually his business. And it was really around the fact that I could explain to him what we do, but he had to turn around and explain it to somebody. And we had to talk about the circumstances when he would be sitting down explaining, what was going wrong and why it was going wrong, and what even meant by it going wrong. And so I think, 5% I think is just a number that people use. It's not optimal from an asset allocation perspective, but if in 2008 you had a 5% allocation to managed futures and it was up 15% and everything else was the sea of red, that small allocation can still be a beacon of green for an advisor dealing with clients who want to sell everything.
We want more than 5%. As managed futures purveyors of a significantly differentiated product that is in particular adding value in the last 6 months. And as I think you've mentioned earlier, Andrew, these sort of regimes tend to last a decade, and sometimes multiple decades. We've been in the 10s, which were largely a very large tailwind for more passive products. Domestic US 60-40 being at the 99th percentile of Sharpe ratio is fairly significant outperformance over a decade. And things do tend to move around. I mean, the last time we got to this, oil was at $9 a barrel, gold at 200, and the NASDAQ was at 5,000, and the NASDAQ didn't hit 5,000 for 14 years. And those other things did very, very well. So, part of diversification is, having some stuff in your portfolio that's always killing it, and then having something that's kind of killing you. And that's, part of rebalancing is a wonderful tailwind at that point. Is there anything else that you're able to share with advisors and with me even on how you get folks across the line on moving towards these more lowly correlated, strategies and then sticking with them? Is there any other kind of stories or analogies that you use that that can help, the advisor out there introduce managed futures or introduce long short or introduce these other a little bit more, even though you're transparent, they are opaque to them. When they hear the NASDAQ, they're on CNBC and they watch whatever's going on in the market. They know kind of what their portfolio is doing, but they have no idea what's going on in their managed futures portfolio. It could be up a lot. It could be down a lot. How do you help with all of that?
So I think, first of all, I think the conversation is a lot easier today than it was a year ago. I wrote a paper in the beginning of 2021 that was basically saying hedge funds think inflation really might be coming back, and here's why managed futures would be a good place for retail portfolios. I mean, that was a crazy
outrageous at the time.
At the time, outrageous. And I just put it up on LinkedIn again today, and I was like, guys,
FYI.
this one has aged well. I think we're up 22%, and the LQD is down 10% over that period of time. So, and then I wrote something last summer about how hedge funds became the new fixed income substitute. So I think people are being taken by what's happening with 60/40 portfolios. What people say about us, hopefully, that they say that our secret weapon is that I'm not a quant. That like when I posted a LinkedIn thing on managed futures, and all these managed futures luminaries chimed in, and they're all talking about these incredibly technical terms. And I kind of responded, and I was like, guys, managed futures should be really simple. Like it's, you asked a question, is it trend? Is it trend reversal? Is it this? Is it short-term trend? It's our portfolio. When I look at it, it's kind of obvious. It's that when interest rates start going up, we start shorting treasuries. It's not a surprise. These guys aren't trying to catch an inflection point. I mean, there are a few guys who try, counter trend and things like that, but when gold is going up, we're going to be owning gold. If equities start going, we're now short equities. If equities keep going down, we're going to be short equities. I mean, people love to take these strategies and dress them up in incredibly complicated language that I think can undercut the ultimate messaging. What I would tell people about a strategy like managed futures is back the way I started, which is that we all have this bias that that if I think my house is worth $500,000 and then somebody tells me it's worth $400,000, my instinct is it's going to come back to 500. Not that it's going to go from 400 to 300 to 200 to 100. And so, here's a strategy that it is a robot dog strategy. It looks at what's going on in the market and it just jumps into trades, but it does it in an intelligent way. It's not saying, oh, look, Bitcoin is up, I'm going to go 100% into Bitcoin. Oil is up, I'm going to go 100%. There's an intelligent way of saying, I want some of this. The euro is going down. I want to short some of the euro. I think that, it looks like that's going to keep continuing. Rates are going up. We're going to be positioned for different ways for the rates going up. If European stocks keep going down, we'll be short European stocks. And so I think when you talk about it as a benchmark plus product, you take a lot of the advisor anxiety out of the equation. Because one expression we coined is that basically the benchmark's your best friend or your worst enemy. And it's your best friend because none of us knows whether managed futures will be up 5% a year or down 5% a year over the next 5 years. But worst case scenario, it's down 5%. If we've cut out all fees and expenses, we don't have the netting issues that you've described, and we're down 1 when they're down 5, the advisor can still frame that as, look, this is diversification, because if that's happening, then probably everything else is shooting through the moon. And on the other hand, if managed futures, if your benchmark when you're sitting across from the client is up 5% and your guy's down 10, that's the nightmare scenario. Because the trigger high, if having picked a guy who you thought was the best in the space, it now turns into this, multi-year hangover of going back and revisiting and what do you do and what do you do. So the idea of getting people to be longer-term investors in the space is a clearer narrative about what it's supposed to do.
What's really
what's funny?
I'm
benchmark.
you know, I to me, like like based on what you just said, Andrew, which is that, managed futures should be a very simple discussion. Um, it just struck me that, this is exactly what investors think their advisors should be doing, right? Like one day, like this last little period, gold is up. And then you get a phone call from your client. Your client says, "Oh, gold's up. Should we be buying some of it?" And one way or another, you have an opinion on that. Either it's yes or no, or maybe, I don't know, and or nothing happens, right? And so the client is like, "Oh, okay, well, Pierre doesn't know." Right? But what I'm hearing, like what I understand from the managed futures discussion that we're having, is that if you have that in your portfolio, you don't have to consider the question and then the decision to do that or not to do it. The managed futures program will do it for you because it's trend following.
I like that explanation. I would say a big caveat in that everyone who likes what we do is building models for their clients. And the whole point of building models, like there was this whole revolution of advisors building model portfolios. Like 15 years ago, if you went in an advisor in the US, they would wave around an Apple analyst report and tell you they're going to buy Apple stock for you and do tax loss harvesting and buy these various bonds. After the great financial crisis, every major wealth manager pushed their advisors to use model portfolios. And it was to get clients to focus on the overall portfolio, not the sleeve. And then to get them to focus on client acquisition, client management, et cetera, and to make them better at what they do well, not what they don't do, and take them away from what they don't do well. In the model building world, you care about how that managed futures is a bucket, and what you care about is how managed futures as a category does over the next 10 years, and if you do as well or slightly better than that. That's very different than, that conversation is very different than the guy who is expecting to be tactical and nimble. Because
I'm just coming at it from the perspective of the client themselves, like the layperson who says, "Oh, tech stocks are down. Should we get out? Gold is up. Should we get in?" And because they're reacting to the daily news that they read, or CNBC or whatever's happening, and so I'm just going back thinking, my advisor days when clients would phone up, on any given day and ask questions like that, and you had to give them an answer and you had to make a decision.
It can be even a little bit insidious and worse than that. If you look at the model portfolio world and you look at competing for those clients, if you would have added 5, 10, 15% of managed futures, whether it was market-based, the best performer, the worst performer, it doesn't matter. That shit was a drag on your portfolio. And the guy who did 60-40 would have his model portfolio without any managed futures, probably cut his emerging market. I mean, we did a piece on emerging markets. The best emerging markets manager has underperformed the worst U.S. equity manager by 10%. Well, why is that? I mean, it's obvious, right? When I say it, it's like, well, it's been a wasteland in one area and it's been, great in the other. How could you even keep up? You can't, based on your benchmark constraints. So now we extend this to the world of model building and the world of competing for clients as advisors go out and talk to people. And the thoughtful advisors are saying you should have a little bit of this managed futures or these other diversifiers in your portfolio have paid, and that diversification has dwindled. And we are now at, maybe we've reached peak 60-40. I'm not sure. But we can see, as Andrew points out, in the hedge fund positioning, that hedge fund positioning towards inflationary assets happened a while ago. Maybe we should just give a little knock on the door for the advisors. Hey, it's time to start to embrace this diversity in your portfolio. If you don't have any exposure to these other unique strategies that could perform for a decade, now's the time to really start giving this some serious consideration, regardless of how you want to do it. Andrew's products, my products, the whole field, competitive products.
And you shouldn't be holding out for peak 60-40. I mean, you shouldn't be waiting.
No, not at all. You should always be diversified.
But
right? That's the whole point.
The bias is that, it's not over yet,
It's so tough.
Yeah.
The firms themselves have changed their model portfolios. In 2007, I don't think that I saw a model portfolio at a firm that didn't include emerging markets or quality value stocks or even commodity ETFs. Fast forward to this past year, I don't see very many of those things in there. We've gone from minus $35 on oil to $130. Just to Andrew's point earlier, that commodities can go a lot further than you might think they can go in any direction.
I think the other thing that's really interesting and curious to see if it's affecting you in Canada as well is that the asset management industry is an incredibly weird industry, and I actually started to work on curricular material for Harvard Business School around how weird it is, because you have an industry that was a phenomenally profitable industry without a lot to show for it in terms of adding value for multiple decades. And then Vanguard comes out of the blue, and Vanguard's essentially a nonprofit. And so you have Vanguard pricing things at zero, and iShares is going to compete with Vanguard essentially at zero. But every time Vanguard raises $1, they just lower all their fees. Meanwhile, you've got the rest of the industry here, still tens of trillions of dollars, kind of resisting and fighting as they get kind of dragged down to it. Well, where these guys can be cheapest is around 60-40 portfolios. The deepest, most liquid, most easily indexable market. And those guys, in turn, were also competing. Like, I remember getting asked by a large insurer in the U.S. to see if we could build a product for them for their target date fund portfolios. And they were losing mandates over 2 basis points of expenses. And so I think, there is this kind of point where you're like, great, well, I've saved lots and lots and lots on management fees, and I have the cheapest portfolio in the world. Like, take robo-advisors in the U.S. I mean, talk about the growth of cheap 60-40 portfolios, and they're all just variants of the same thing. And part of our whole business thesis is that in the next 10 years, it's all going to change. And when it starts to change, it'll be the pile-on effect. I wrote a joking post on social media where I said, I'm waiting for the moment where we have hoarding in managed futures.
Yes.
Like
Andrew, you've recently in the last year or so, you've been quoted as saying that you foresee us entering a new sort of golden era for hedge funds.
Yeah. I was right on 2020 and wrong on 2021, but
era.
Let's call it a decade. How about that? Era, yes. Okay.
So what's giving you the confidence in that?
Thanks.
I think
what is it that you're?
It's everything that you're saying. It's that emerging markets have been, bad, even worse. I mean, look at it last year. I mean, who expected China to step on the neck of the tech industry and the real estate industry and then have a COVID outbreak? I mean, you look at the tech sector in China is down 75% in a year. I mean, it is mind-boggling. But that being said, there will be tremendous opportunities around that. There will be, whether it's on the equity long-short side, when equity long-short managers generated more alpha in 2020 than the entire preceding decade, because they got the releveraging. They went into the crisis with a tech bias. They got the recovery early, because every epidemiologist worth its salt was also retained by hedge funds to try to figure out when vaccines were coming and when. And they bet, and as a result of that, they bet on the recovery trade. And so when you had this big swing back into value, they were there waiting for it. And so 2021 was actually one of the worst, interestingly. But not to say that they're going to get everything right, but that just there are going to be so many more fish in the pond over the next decade. And that's where there will be different ways to capitalize on it. You guys, I'm sure, will find lots and lots of different ways to identify things that have been historically cheap or interesting to invest in. I like hedge funds because I think on average, they're going to find, when I talked about you talked about emerging markets in the 2000s, it wasn't a hidden trade. It was just that these guys went into it with much greater scale and size in their portfolios, and they got in early, and they rode it when when emerging markets were outperforming the S&P by 30% a year. So I think you're gonna see a lot of opportunities like that. Sometimes they'll reverse and get ugly, but on average, it should be a great decade.
That emerging market.
I was just going to say, where are you seeing the most uptake in terms of your two main your main products, your main ETFs? Who are the buyers of DBEH and DBMH? Is it DBMH? Yeah. DBMF, pardon me.
So DBMF. Yeah. So all the interest is on the managed future side. And I mean, equity long short is candidly a defensive equity allocation. It's got less equity risk. If you do really well, you're going to do 200 basis points of excess returns. Managed futures, you line it up against equities, and we've got 0 beta since we started, and 800 or 900 basis points of annualized alpha. It's where all the diversification bang for the buck is. What we do from a fee disintermediation perspective moves the dial a lot more. The other things that we also manage are portfolios that combine those two, and where you combine them. In Europe, we have a product that we manage for a big asset manager called FDI that's among the top performing multi-strategy UCITS funds since we launched, because that's where we combine managed futures and replication of equity long short and relative value and event driven all into one package. And that goes back to this idea that there is a large group of investors who don't want to worry within their hedge fund bucket in their asset allocation model. They want a low cost, client friendly, one-stop solution that does 200 basis points a year better than the benchmark. And they want to buy it, put it across all of their, portfolios, as you say, below a certain size, not the $100 million guys, not even the $10 million guys, with the smaller clients, and then just use it as their allocation.
Yeah, that makes a lot of sense to me. I can see why.
But look, there are a lot of things we don't do, right? I mean, it's like there are, and we don't, when people talk about DBMF. If commodities go straight up, you could have more commodities than we will ever give you in that portfolio. In our European portfolios where we can't own gold and oil, we're long the Canadian dollar and long the Aussie dollar. Being long the Canadian dollar probably wouldn't do much for your clients, but I think the key is to be very, very focused on what it is you're trying to achieve. And what we're trying to achieve is balancing. I want exposure to this hedge fund strategy. I have an asset allocation model. I want something to fill the bucket without getting me into trouble. And so some people say it's like the sleep at night version of investing in hedge funds. Some people say it's sort of the asset allocator's dream.
Right.
But again, we're talking about people who already have an asset allocation model, who are looking to fill a bucket and to fill it with and so all of our products have been built with that person in mind.
Do you ever find that the managed futures moniker gets in the way of interest?
All the time. Some people call it CTAs in the U.S. People don't. I mean, it's like a lot of people that initially, when the ETF was small, I would talk to people that didn't know what a futures contract was, and they didn't know, therefore, what managed futures meant.
That's what I was going to say. Why don't you call it something? Why don't you call it something else? Because I think when it comes to futures, people start thinking about Randolph and Mortimer, right?
And that Yeah, I mean, I would say that the uptake that we get uptake from sophisticated advisors, and most of them.
No, obviously it's not an issue, but if you're trying to introduce the idea into a more mainstream, cohort of the market, and to lay clients, lay people, to the average client. at first, obviously, it's the advisor's job to take up the responsibility, the mantle of educating their clients on what exactly what managed futures are. But I guess what I'm getting at is that at the outset, that terminology can confound the activity, right? It can actually get in the way of the activity itself.
Oh, even at the term hedge funds. I mean, I think So what's interesting about so one of the things that's interesting or fun about my job, I would say, is that when I talk to an advisor, I have no idea where the conversations go. Like there's no canned pitch about this. I need to understand what they do, what their clients are like. I spoke to a guy earlier today. Most of his clients, they have full discretion over client portfolios. There's not a lot of communication with clients about why they're putting something into the portfolio versus something else. Right? He has a huge advantage in terms of being able to build the portfolio, because the term managed futures probably never makes it back to his clients. It's probably this is in as a fixed income hedge or something like that. For the clients, for advisors who have to explain things on a line item by line item basis, managed futures is hard. It's hard to explain. It's quantitative. It's easier to say, here's a guy who picks cheap stocks, things that are worth less than they're trading at. People can understand that language more. And it also arms you with a defense that, oh, well, it went down. We bought it at 20, but it's at 15 right now. Well, we don't want to get out now because it's even cheaper than it was, as opposed to maybe it wasn't worth 20 in the first place. It's like an easy narrative around it. Managed futures is really hard on that. We invested in a guy who was short-term trend, and then he just got whipsawed 6 times in a row, and he's down 15%. So I think what I try to do is understand the person on the other side and what are their real actual business considerations, and if they'll share that with me, then we just really talk about it. How, if I was sitting in their shoes, how would I try to explain it to people? For some people, it's as simple as it's an inflation hedge.
I think it starts there. The regime shift that I would say most people aren't prepared for isn't just the inflation, it's the inflation volatility. So we have now inflation, but the volatility around the inflation, that variance around the mean, has been exceedingly low since 1990. AHL Mann put out a paper on this, which I think is about 1.3%, and historically before that was like 5.5%. So it's almost a factor of 3 times larger. That has all kinds of negative implications for risk premiums on equities and bonds, very significant ones. And it also has negative implications on their correlations. Like the 1970s saw stocks and bonds correlated because of the inflationary environment. Correlation means you are not getting that zigzag benefit of negative correlation that stocks and bonds have enjoyed. And so you're going to see your 60-40 portfolio move more violently. What is the thing that can solve that? Well, exposure to commodities. Now, the challenging thing is, even in the 70s, when commodities compounded at 14% real and stocks and bonds did negative real, there was still a 3-year period in there where your portfolio of commodities on a market cap basis was down 37%. Trend followers who were in that weren't down 37%. Risk parity type portfolios that allocated on a risk adjusted, on a risk weighted basis to commodities did not experience that. So it's not just, a dumb allocation, as Andrews says. I mean, you've got to think about this through the portfolio construction lens. And then, an advisor that we spoke to the other day, just to add some color, they wanted to actually bury the managed futures side of it into an overall portfolio, cloaking it, obscuring it, basically saying the client doesn't need to see it because we're going to have to answer questions about it. And the behavioral vulnerability is of the clients wanting to sell the thing that's not working rather than to rebalance into the thing that is not working because it's had a period of low returns, which is behaviorally more optimal. This is the extent some very thoughtful advisors are going to make sure they have allocations across these different types of managers. And I think this is probably what Andrew's clients in Europe with the UCITS funds were going for too. They don't want to see the line items.
Oh, no question. Yeah, no, it's look, I actually like the idea of
Yeah.
combining. I mean, we have these two ETFs. I do like the idea of combining them because I want something. Again, it's not a scientific analysis, but I think if the equity markets do really well, I feel confident that the equity long short guys it's probably going to be an environment where he's doing better. They're doing better than on the managed future side. I mean, I think going back to your point about communication with clients
Yeah.
and stuff. I think there is I found that there's a lot of power in anecdotes. And so last year we were short the Japanese yen, and the Japanese yen was going down. Right? That if the client had a 5% allocation in it, and this was not going to save them in terms of what they were doing, but it was very useful in terms of having a concrete example of an exposure you're not going to get elsewhere. Like if the Japanese, Japan hasn't grown in a long time. They're never going to raise rates in Japan because they're never going to have inflation in Japan for all these different reasons. That actually was not a difficult argument to say to a retail to the end client, but it was really just it was having something tangible, almost like if you said with a guy who is picking stocks. Oh, he's buying the stock at $16, and his analysis says it's worth 25.
Yeah.
That it's powerful. It's a powerful story that makes it tangible for the client and what you're trying to do. When you take managed futures away from beta, alpha, non-correlation and other things like that, to me it's about stories. And so around when I wrote this thing about the inflation trade and people were saying, well, how do I describe to you? I said, look, if inflation hits, most guys are not going to have things in their portfolio that will directly make money from it. Now, you and I know that means shorting treasuries, but you can frame that with your clients in a way that takes that and frames a story around it. That if inflation goes up, these guys will be long inflation, whatever that means. And so I think a lot of it is finding a way to craft narratives around it. Right now, we are short the euro. That's not a hard trade to explain to people, given what's going on.
Yeah.
It's not working today.
But the capital flight story is
it was working until
goes
today.
hand in hand with that, right? So the exodus.
Well, and I think the other thing for advisors that
But
will
I think
often
it's
have
hard.
is,
I think
we're trading 85 different futures and currency markets, and so those are just things that you don't have access to. And then we're looking at them through the lens of being long or short. And one of the ways in which to take advantage of inflation is to be short bonds or short the bond complex. So how many advisors can actually execute a short in the bond markets and efficiently? They can't. How many can trade the grain complex? Can't. I mean, you could maybe get away with a long gold position in the metal side of things, maybe have some silver, and that might be acceptable in the current client zeitgeist, depending on what country you're in. But these things are just significant diversifiers that come to play when you have an inflationary volatility market. And it seems like I think both Andrew and I are trying to convey that regime shift is occurring. The deglobalization and onshoring of supply chains, that's a major shift from 1989 and the collapse of the Berlin Wall and the massive globalization that we encountered, and then interest rates falling for 40 years. All of these things seem to be at a moment of change in regime. And that change in regime and then change in inflationary and growth dynamics and liquidity dynamics has significant and long-term implications for how asset prices behave. And so this isn't your father's market. It might not even be your grandfather's market. It might be your great-grandfather's market.
You had me at giving you access to things you don't have access to.
Right. There you go.
I think also, this is where it again depends, but I also,
Yeah.
I wrote something for family offices, which is basically why every value investor should have managed futures. And it was because, I know a lot of family offices who everybody that they invest in has a value bias in one way, shape, or form. And well, they did. I mean, they probably all have a tech bias at some point, today. But that's the real diversification is, as you say, is somebody doing something you aren't comfortable with, you don't like in some fashion. And so to me, people ask me about the portfolio and how we're positioned. And in one of our portfolios, we went very, very short Europe over the past couple of days. That makes me cringe because that just makes me feel like, it's because I always feel myself personally, I always feel like the market gods are waiting for our portfolios to take a big position.
Yeah.
So they can, they can, bring their boot down from market heaven and stomp on us. But there are a lot of times where I've seen positions like that and they've worked. And it's never something that I would have done on my own. So people often say, well, do you ever override the positions? Do you, and my answer is no, I don't override them because I don't think I would be more right than they are. And an advisor shouldn't think about overriding them because the whole point is, when the yen has gone all the way down like this, and then they're, shorting the yen, expecting to go down further. And there's real value in that in a portfolio. And I think back to your point is when we do have these regime shifts, why do things keep moving? It's because we get this very, very tight consensus. Last year, I mean, it's incredible. End of August, 65% of economists expected no rate hikes this year in the U.S. And then they start moving and they start piling on, and somebody says 2, and then somebody says 3, and then Jamie Dimon says 6, and then Bank of America.
Now we're back to 2 again.
Yeah. And so so back to the trading places thing, that's kind of the typical, pit mentality of emotions building on it. And I think the best thing, the best trades or opportunities that people have found over time, they're often, it's like Warren Buffett says, or Charlie Munger says, it should be blindingly obvious why you're doing it. You shouldn't have to have 4 decimal places to figure out why you're doing something. And I think, to me, right now, managed futures is blindingly obvious.
That is a great spot.
Given the world that we're in.
Put a pin in this. We've been at it about an hour and a half, but that's,
Yeah.
Mic drop.
That was an amazing discussion. Amazing conversation. You have to say. Yeah.
Click. Yeah. Listen, thank you
Andrew,
guys so much.
Yes, let everyone know where they can find you. The specifics, like your Twitter handle, the website, all the stuffs where people can dig in, find some of those white papers you were talking about all along the call.
Sure. So everyone, first of all, I publish a lot of stuff on LinkedIn. So just reach out to me over LinkedIn. It's Andrew Beer, BER, like the drink. My company is called Dynamic Beta Investment. And then you'll see kind of a steady stream of things that are going on in the hedge fund space, occasionally, tossing rocks or at different cannons of the industry. And then on Twitter, it's Andrew D. Beer 1, I think it is, but in any case, it's the same. And then we have a website, www.dynamicbeta.com, where we do publish research. Despite my listing a couple of articles, I publish things relatively rarely because I only write things when I think I have something
excellent,
interesting to say.
Well, Andrew, thank you very much. I want to say that was very enlightening. I know I said it at the beginning; it was going to be an enlightening and insightful conversation, but I think that's an understatement. That was amazing.
Thank you guys very much for having me on. It was a pleasure, and I hope we'll have an opportunity to do this again in a couple of years, talking about year 3 of the Great Regime Shift.
Oh, yeah. Let's all remind ourselves when we're really popular that we're near the end.